Imagine a world where money isn't just, the paper in your wallet or numbers on a bank statement. Imagine it as a truly digital asset that you control. It moves across the globe instantly, securely, and maybe with unprecedented privacy. That future, it isn't just coming, it's actually already here, and it's fundamentally reshaping how we think about value and transactions. Today, we're diving deep into the foundations of this whole revolution, and we're guided by Antony Lewis's fantastic book, The Basics of Bitcoins and Blockchains.
That's right. And our mission here really is to cut through all the noise, bypass the jargon, and give you a really crystal clear understanding of digital currency and this blockchain technology. We're going to trace the journey from the history of money itself right through to the nuts and bolts, the mechanics of Bitcoin. And then we'll zoom out a bit to look at the broader implications of blockchain for, well, our financial future. By the end of this, you should feel genuinely well informed.
Okay, let's unpack this then. We often take money for granted, right? But what exactly gives it its power? Lewis's book reminds us of money's three core jobs, its functions.
Yeah, fundamentally, money needs to do three things to work properly. First, it's a medium of exchange. It just simplifies trade so you don't have to, swap your chickens for my shoes.
Right. Barter is messy.
Exactly. Second, it needs to be a reliable store of value, meaning its purchasing power holds up over time, hopefully. And third, it acts as a unit of account. That gives us a consistent way to price things, whether it's a coffee or a car.
So when we talk about good money, you'd think the U.S. dollar, with its global acceptance, would be the gold standard. But the book throws a bit of a curveball here. It highlights a significant challenge: the dollar's role as a store of value. It points out its purchasing power has actually fallen by over 96% since the Federal Reserve System was created back in 1913. I mean, that's a staggering figure.
It really is. And look, this isn't just some historical footnote. It highlights a fundamental tension in traditional finance. Can any centralized currency truly be a perfect store of value when, its supply is managed by human institutions that can be influenced by politics, by economic pressures?
Yeah.
This very question fuels that ongoing debate, and it's precisely where something like Bitcoin enters the conversation. It offers a radically different approach.
Okay, that's a great setup. So how does Bitcoin, this sort of new kid on the block, how does it stack up against those three core functions?
As a medium of exchange, it's fascinating. Bitcoin enables truly peer-to-peer transactions. You can send value directly to anyone, anywhere, without needing a bank or any intermediary. That sounds incredibly empowering. But what are the current realities?
Oh, it is empowering. I mean, the idea of value transfer without a third party, without censorship, that's revolutionary. However, as Lewis points out, while it offers this capability, it's not yet, universally accepted everywhere. And transaction speeds can vary quite a bit globally. So for your everyday purchases, like that coffee you mentioned, it's not really widely adopted as a common payment method, not just yet.
Okay. And as a store of value, we hear so much about its price just skyrocketing.
Well, Bitcoin has certainly demonstrated strong speculative investment potential, no doubt, and remarkable price appreciation over time. But the flip side, and it's a big one, is its extreme volatility. Its value can swing dramatically, sometimes in very short periods, and that makes a lot of people hesitant to rely on it as, say, a stable form of long-term savings. It's much more like a high-risk investment than a steady store of value in the traditional sense, at least for now.
Given that volatility, it sounds like it would really struggle as a unit of account.
You're absolutely spot on there. Its price instability makes it largely impractical for everyday accounting. I mean, sure, crypto traders might denominate their portfolios in Bitcoin, but imagine a grocery store trying to price milk or eggs in Bitcoin.
Right, if the price jumps 10% overnight.
Exactly. It's just too unstable for that kind of practical purpose, which is also a key reason why central banks remain pretty cautious about its widespread adoption, given the potential disruption to economic stability.
Okay, so if we're moving towards this digital-first economy, how do we solve that inherent challenge of digital money? The double spend problem. Unlike a physical dollar bill you hand over, digital currency is just data. What stops me from essentially copying and pasting it to spend it multiple times?
That's the absolute crux of it. Physical cash inherently solves the double spend problem. Once it leaves your hand, it's gone. You can't spend it again. Simple. With digital money, you need a trusted system. Usually that means an intermediary to ensure that once you send it, you no longer possess it. This is absolutely fundamental to how traditional banking operates.
Right. Which brings us to how traditional banks actually handle settling these digital debts. especially between different institutions.
Yeah, within a single bank, it's pretty straightforward. It's just internal balance adjustments on their ledgers. Easy enough. But between different banks, it quickly gets complex. You've got networks of third parties involved. And internationally, it gets even more intricate with something called correspondent banking.
Correspondent banking.
Yeah.
Okay.
Yeah, here banks essentially hold accounts with other banks in foreign countries to make cross-border payments happen. The fact that there's no single global central bank means we rely on these, well, often less efficient, multi-layered systems. It's a bit like a game of financial telephone across continents.
That sounds like a lot of trust involved and a lot of steps. What about central banks? How do they try to streamline settlements between the banks they oversee?
Right, so central banks offer some critical solutions for managing these flows. You have deferred net settlement, or DNS. Here, payments are kind of batched up and settled in bulk at specific times.
Okay, so not instant.
Not instant. It helps banks manage their liquidity, but yeah, transactions aren't immediate. Then there's the alternative. Real-time gross settlement, RTGS. This is designed for immediate one-to-one transaction settlements. Money changes hands instantly.
Sounds better.
It minimizes credit risk, definitely, but it typically requires banks to hold higher reserves, more cash on hand. What's fascinating here is seeing how these centralized systems manage risk and liquidity, and then contrasting that with Bitcoin's totally decentralized approach to solving the same core problem.
It's interesting, too, thinking about the push and pull between the efficiency of digital money and privacy. With physical cash, you hand it over, it's anonymous, it's censorship resistant. Nobody's tracking your coffee purchase usually.
Oh.
But digital money, that's
Yeah.
different, right?
Precisely. Digital money's reliance on these trusted bookkeepers, the banks, introduces the need for identity verification. That's your Know Your Customer, KYC, and anti-money laundering, AML, checks. And this creates an ongoing, really robust debate. It's about balancing financial privacy on one hand with necessary legal compliance and preventing illicit activities on the other. It's a big societal balancing act.
And it's in this very context, identity, and trust that we've seen the fascinating emergence of digital wallets. They seem to offer a different kind of financial service, often operating with these e-money licenses, which are distinct from traditional banks.
Absolutely. The rise of these digital wallets and other alternative financial services, fintechs, and so on, it's really pushing traditional banks, pushing them to reevaluate their customer experience, their fees, their very role in this evolving financial system. It's a clear sign of how rapidly things are changing, with new players challenging the old models.
Okay, so with that solid foundation on money and traditional banking, let's actually dive into the engine room. How do Bitcoin and blockchain really work? It seems like it all hinges on decentralization.
It truly does. Bitcoin operates on this vast, decentralized network. It runs open source software called Bitcoin Core. And the genius here, the really clever part, is that any participant can choose to act as a bookkeeper. They maintain an identical copy of the entire transaction history, the ledger. Anyone with the right hardware and software. And this radically enhances security against censorship. It offers a direct solution to those privacy and control vulnerabilities we just talked about, the ones inherent in centralized systems.
And the fundamental bedrock, the security layer for all this is cryptography. How does that translate into something tangible for secure digital transactions?
Right. Cryptography is the digital guardian of this entire system. A core concept here is public key cryptography. Imagine this. You have two keys, one private, one public. Your private key is like your secret signature pin, only you have it. Your public key is like an open mailbox everyone can see. When I want to send you something securely, like a Bitcoin transaction, I essentially put it in your public mailbox. But only you, with your unique private key, can actually open it and access what's inside. This clever setup eliminates the need for shared secret keys, which historically were a huge security challenge. How do you share the secret securely in the first place?
Got it. So if I use my private key to sign a transaction, that's what we call a digital signature, right? And how does that prove it was really me without a central authority checking?
Exactly. So let's say you, Alice, want to send Bitcoin to Bob. You sign the transaction using your private key. This creates a unique digital fingerprint for that specific transaction linked to your key. Now, if anything in that transaction message gets altered, even a single digit, the amount, the recipient, that signature becomes invalid instantly. This is how the entire network can verify, mathematically, that only the true owner of the private key authorized the transfer. And it also proves the transaction hasn't been tampered with since it was signed. It's like an irrefutable digital stamp of approval, establishing trust without needing a bank in the middle.
And then we have hashes, which sound a bit like a super-powered digital fingerprint for data itself.
They kind of are. Cryptographic hashes are what we call deterministic functions. Think of it like this. If you put a specific document, say a block of transactions, into a hash function today, you'll get a unique fixed-length output string, like a shortcode. If you put that exact same document into the same function a year from now, you will get the exact same output string. But if even one tiny character in that document changes, the hash output will be completely different, unrecognizably different.
Wow.
This is absolutely crucial for verifying data integrity across the entire blockchain. It's how all those bookkeepers can instantly confirm that no one has tried to secretly alter past transactions.
So how do all these secure, cryptographically protected transactions actually become part of the permanent Bitcoin record, the blockchain itself?
Right, so once transactions are broadcast and verified by the network nodes, they get bundled together into what we call blocks. These blocks are then added to the existing chain of blocks, the blockchain, roughly every 10 minutes.
Every 10 minutes.
Approximately. This controlled frequency is key. It's designed to allow enough time for transactions to spread across the network and for the decentralized bookkeepers to reach a consensus on which block is the valid next one. And the more blocks that get added on top of the block containing your transaction, the more secure it becomes. It gets increasingly difficult, computationally speaking, almost impossible to go back and tamper with it. It's kind of like pouring layers of digital concrete over that document. The more layers you add, the more permanent and immutable it becomes.
Okay. And who does all that heavy lifting, creating these blocks? That's where the term mining comes in, isn't it?
Precisely. Miners are the participants who compete to create these new blocks. They use immense amounts of computational power to solve a complex mathematical puzzle. It's the famous proof of work mechanism.
Right.
The first miner to find the solution gets the right to propose the next block filled with pending transactions to be added to the chain. And their incentives are pretty clear. First, they earn the transaction fees from all the transactions they include in their block. And second, they receive a reward of newly created bitcoins. This is the block reward.
Oh, so that's where new bitcoins come from.
That's primarily how new bitcoins enter circulation. These block rewards diminish over time, though, through a process called halving, which happens roughly every 4 years. This controls Bitcoin's total supply, making it finite. Now, technically, anyone can participate in mining, but realistically, it requires significant investment in specialized hardware and consumes a lot of energy, making it a highly competitive, often industrial-scale endeavor today.
It sounds like a lot of power and responsibility involved there. Which brings us to ownership.
Yeah.
The book really clarifies that owning Bitcoins isn't about having them in your wallet like cash. It's about possessing the private key.
Yes, and this is such a critical distinction that often trips up newcomers. Your Bitcoins aren't physically stored anywhere, like in a digital vault. They simply exist as transaction records on the public blockchain. Your wallet doesn't actually hold the Bitcoins. What it holds securely are your private keys.
Okay, the keys are the crucial part.
The keys are everything. And importantly, your wallet software uses those keys to track your unspent transaction outputs, or UTXOs. Think of it like this. Imagine your Bitcoin balance isn't a single number in an account. Instead, it's like a collection of distinct digital notes or coins that you've received from various past transactions, like individual dollar bills in your physical wallet.
Right, like change you've received.
Exactly. Your wallet keeps track of which of these specific digital notes, these UTXOs, are still yours and available for you to spend. And here's the kicker. If you lose your private key, maybe your hard drive fails, you lose your backup, you permanently lose access to those digital notes, those UTXOs. They're still on the blockchain, but you can't prove ownership anymore.
Wow, so no forgot password option.
No forgot password option, no central authority to appeal to. This is the essence of being your own bank. It offers incredible control, autonomy, privacy, but it places the full burden of security and responsibility squarely on your shoulders.
So the Bitcoin ecosystem isn't just about miners then. There are other players.
Oh, not at all. It's a really vibrant ecosystem. You've got the miners doing the proof of work. You've got the network's bookkeepers, often called full nodes, verifying transactions and maintaining the ledger. Then there's the vast community of users actually sending and receiving Bitcoin. And, of course, the exchanges that facilitate buying, selling, and trading.
And how is it governed? Are changes made?
Well, governance largely happens through a kind of rough community consensus process.
Oh.
Often, proposed changes are formalized through what are called Bitcoin Improvement Proposals, or BIPs. These get debated, tested, and eventually adopted or rejected by the community, particularly the node operators and miners. However, it's also important to acknowledge ongoing discussions and debates about potential centralization risks.
Like what?
Well, for instance, concerns about who controls the core software development or the concentration of mining power into just a few large mining pools. These are active areas of discussion in the community.
It sounds like a robust, kind of self-sustaining system in many ways. But Bitcoin isn't the only digital asset out there, far from it. Let's talk about the broader world of digital tokens and the, frankly, dizzying variety of blockchains.
Yeah, this is where the landscape truly explodes in complexity and possibility. While cryptocurrencies like Bitcoin, BTC, and Ethereum, ETH, are foundational, tracked on their own unique blockchains, the term tokens is much broader. Tokens are often issued through things called initial coin offerings, or ICOs, which we'll get to, and they're typically tracked within smart contracts, especially on platforms like Ethereum. The term token itself can mean many different things, depending on the context. It's a bit like trying to call all wheeled vehicles cars. It's not quite accurate.
Okay, so there are many diverse types of tokens beyond just trying to be digital currency, right?
Absolutely. You have currency tokens like Bitcoin or maybe XRP, which are designed primarily for value transfer like digital cash. Then you have platform tokens like Ether, ETH for Ethereum, or EOS. These are essential for powering a specific blockchain platform. They're kind of like the fuel needed to run that network's operations.
Right, you need them to do things on the network.
Precisely. Then there are utility tokens like Augur's REP or Siacoin, SC. These grant you access to a specific product or service within a particular project's ecosystem, like a digital coupon or access pass. And we're even seeing the emergence of brand tokens like the basic attention token, BAT, or civic, CVC, which are often linked to consumer engagement, advertising, or loyalty programs.
Ethereum in particular seems to have really expanded the possibilities far beyond just digital cash.
Mm-hmm.
What are its unique contributions?
Yeah, Ethereum was definitely a game changer. While Bitcoin largely established itself as a sort of digital gold focused on value transfer and storage, Ethereum aimed higher. It focuses on decentralized computation and this revolutionary concept of smart contracts.
Smart contract.
Imagine self-executing agreements where the terms are written directly into code on the blockchain. They automatically enforce rules and execute actions when certain conditions are met. This automates processes and enables really complex transactions and applications far beyond simple currency exchange. And yes, to run these computations and transactions on Ethereum, you pay fees in its native token, Ether, using a mechanism called gas.
Gas, like fuel.
Exactly like fuel.
Mhm.
Think of gas as the payment needed to power the Ethereum engine. It incentivizes miners or validators now with proof of stake to process your transaction or execute your smart contract. So Ethereum's broader application range for decentralized apps, or dApps apps, and the whole world of decentralized finance, DeFi, is what truly sets it apart. It has more advanced scripting capabilities than Bitcoin, generally shorter block times meaning faster confirmations, and arguably a more defined, though still evolving, governance structure, partly due to the influence of figures like its co-founder, Vitalik Buterin.
You mentioned initial coin offerings, or ICOs, earlier. They really boomed for a while as a fundraising method for these new tokens and projects, didn't they?
Oh, they absolutely did. For a period, ICOs became this incredibly powerful modern fundraising approach. Companies could issue new digital tokens directly to investors all over the world and basically bypassing traditional venture capital routes or stock market listings.
So much lower friction.
Much lower friction, much wider reach. This allowed them to appeal to a huge array of global backers. A crucial document in this whole process is the white paper. This typically details everything from the project's goals, the underlying technology, how the funds raised will be used, and the team behind it all. Essential reading, supposedly.
Supposedly, yeah.
Exactly, because ICOs quickly face significant regulatory scrutiny, and for good reason. There are many scams. Frameworks like the Howey test in the U.S. started being applied to determine if these tokens were, in fact, unregistered securities.
Right, that's a big deal legally.
Huge deal. And regulatory bodies like FINMA in Switzerland started trying to categorize tokens payment, utility, asset tokens to bring some clarity to their legal status. And of course, the significance of getting these newly issued tokens listed on major cryptocurrency exchanges cannot be overstated. That's what provides the crucial liquidity and price discovery for investors who bought into the ICO.
Okay, and it's not just different tokens. We also need to understand that not all blockchains are created equal. There seems to be a fundamental difference between public and permissioned blockchains. Can you break that down for us?
Yeah, that's a really vital distinction to grasp. Public blockchains, like Bitcoin and Ethereum, are built on principles of openness, transparency, and decentralization. Anyone can join the network, anyone can send transactions, anyone can download and verify the entire ledger history. It's permissionless.
Okay, open to all.
Open to all. Permissioned blockchains, on the other hand, are designed for specific, often private or consortium groups. They only allow pre-approved, identified participants. Think corporations collaborating or banks settling specific types of transactions. The focus here is on trusted transactions among known parties. It's like an exclusive club with a guest list versus a public park anyone can enter.
Right. Less about trustless and more about trusted.
Exactly. And because participants are known and trusted to some extent, permission chains often don't even need their own native cryptocurrency or token for incentives. But what generally unites all types of blockchains are some common underlying features. They are essentially distributed data stores that record changes chronologically. They use real-time data replication across a peer-to-peer network architecture. And they rely heavily on cryptographic methods like hashing and digital signatures for security and integrity.
Despite all this amazing innovation, there are still some pretty prevalent misconceptions floating around about blockchains, aren't there? The book really emphasizes this point.
It does, and it's a crucial one to understand. A huge misconception is that blockchain is some kind of universal magic bullet needed for every single data processing situation. It's just not true. The author, Lewis, uses a fantastic analogy. He describes blockchain not as a single monolithic technology, but more like a collection of technologies, a bit like a bag of Legos.
I like that.
Right. You can assemble these different components, decentralization, cryptography, consensus mechanisms in countless ways. And the reality is often traditional technologies like standard databases or secure communication protocols are perfectly sufficient. They're often more efficient, less complex, and cheaper for many, many applications. Just because you have a hammer doesn't mean every problem is a nail, you know?
Good point.
The real insight here is understanding when blockchain truly adds significant value. And that's typically in situations where you need trustless environments, where participants don't necessarily trust each other, or where you need decentralized control, censorship resistance, and highly immutable records, not just for storing data efficiently.
Okay, so with all this complexity and potential, it's no surprise many people are looking at crypto assets as an investment. But how on earth do you actually value them? Especially when, unlike company shares, they don't usually represent claims on underlying assets or cash flows.
Yeah, valuation in crypto is a notoriously complex. It's probably the hardest question, precisely because, as you said, they don't typically have traditional assets or earnings backing them. Lewis kind of boils it down to three key questions investors are always grappling with. One, what is the current market price? That's easy enough to find. Two, what are the underlying causes of its price changes? That gets trickier: market sentiment, adoption news, regulation fears, macroeconomics. And three, the most challenging, what should the price fundamentally be? What's its intrinsic value, if any? It's a completely different paradigm from valuing a traditional business with predictable earnings and tangible assets. It's much more based on network effects, potential future utilities, scarcity models, and, let's be honest, a lot of speculation.
And as with any investment, especially in such a new and frankly wild market, there are significant risks involved. What are the main pitfalls investors should be really keenly aware of?
Oh, definitely. The primary risk, as we touched on earlier, is just extreme volatility. Prices can fluctuate wildly. I mean, double-digit percentages in a day sometimes. And the value of an asset can quite literally drop to zero or near zero due to hacks, major protocol vulnerabilities being discovered, or just a simple, sudden loss of market confidence.
Scary stuff.
It can be. Then there's liquidity risk. If you decide to invest in a smaller, less popular coin or token, you might find it difficult to sell it quickly when you want to, or at the price you expect. The buyers just might not be there. Exchange risks are also really significant. History is unfortunately littered with examples of crypto exchanges being hacked, going bankrupt, or just freezing withdrawals, resulting in users losing all their funds held on that platform.
Right. Not your keys, not your coins, as they say.
That's the mantra. So the crucial advice here is, if you're not actively trading minute to minute, withdraw your crypto funds from the exchange to your own secure wallet where you control the private keys. Only keep funds on an exchange that you can genuinely afford to lose.
And as you mentioned, your own wallet has its own set of risks, too. It really embodies that whole being your own bank responsibility, for better or worse.
Absolutely. There's a fundamental trade-off you have to make. Online wallets, or hot wallets, connected to the internet are definitely more convenient for frequent transactions. But they carry significantly more risk because they're exposed to online threats like malware and phishing. Hardware wallets, or cold wallets, keep your private keys completely offline. They offer vastly superior security against hacking, but they're less convenient for quick access. This choice directly reflects the level of security responsibility you're willing and able to take on when you become your own bank. And finally, investors absolutely must navigate regulatory and scam risks. Regulations are constantly evolving country by country. Things like tax obligations for crypto transactions are becoming much stricter. You need to stay informed.
Definitely.
And sadly, the crypto market is still rife with scams. Sophisticated Ponzi schemes, pump and dumps, fake ICOs promising the moon, they're everywhere. Doing thorough research, being skeptical, and exercising extreme caution are not just advisable, they are absolutely essential before putting any serious capital into this space, if it sounds too good to be true.
It probably is. So with all these rapid developments, incredible potential, but also these inherent risks, what's the general future outlook? Where does the author see this rapidly evolving space heading?
Well, Lewis predicts continued innovation intensification. Basically, the pace won't slow down. It'll likely accelerate, largely driven by the powerful financial incentives for talented developers and entrepreneurs to create new projects, improve existing ones, and find new use cases. We'll also likely see more widespread tokenization of assets. This means representing real-world assets or new kinds of digital assets on blockchains. Think beyond finance into areas like digital collectibles, NFTs, enhancing virtual items in gaming, and perhaps most impactfully, the continued rise of stablecoins, cryptocurrencies designed to maintain a stable value, pegged to something like the US dollar to try and mitigate that crazy volatility.
Stablecoins seem key for usability.
They could be. There's also a clear push towards greater standardization and regulation across the industry. This might sound counterintuitive to the early crypto ethos, but it's probably necessary. Clearer rules and industry norms are needed to bring clarity, reduce scams, and encourage broader institutional investment and mainstream participation.
And how will the underlying blockchain technology itself continue to evolve to meet some of those challenges we discussed?
Yeah, big challenges remain. Things like scalability, how to process more transactions faster and cheaper, and the significant energy consumption associated with proof-of-work systems like Bitcoins. These will undoubtedly continue to drive evolution. We're already seeing a major shift towards alternatives like proof-of-stake consensus mechanisms, which are vastly less energy-intensive. Lewis himself seems quite optimistic overall. He believes cryptocurrencies will evolve to provide tangible, real-world value, leading eventually to the emergence of truly robust and reliable stablecoins that offer genuine price predictability. He also suggests that governance structures for these decentralized networks will likely need to mature and become more formalized. Platforms without clear, adaptable governance mechanisms might become less viable or acceptable over time as the space professionalizes.
Wow. Okay. You've just taken a really fascinating journey with us, right from the very definition of money, through the complex intricacies of digital transactions, the ingenious mechanics of Bitcoin and other cryptocurrencies, and then zooming out to the broader, ever-evolving landscape of blockchain technology. We've seen how these innovations are challenging traditional financial systems and really unlocking entirely new possibilities for how we interact with value itself.
Absolutely. And as these financial systems continue their rapid evolution, this increasing disintermediation, cutting out the middlemen brought by blockchain technology, means that you, the individual, potentially have more direct control over your digital assets than ever before. Now, this shift offers the incredible promise of reduced costs, greater efficiency, maybe more financial inclusion. But as we've stressed, it also places a much greater burden of security, understanding, and personal responsibility squarely on your shoulders.
So the provocative thought to leave you with is this. What new forms of good enough money will emerge in this increasingly decentralized future? And perhaps more importantly, how will you continue to adapt, learn, and navigate this rapidly changing, exciting, but also challenging landscape of digital value?